FAR.F5.M5.
Today we're taking net income and asking the question every skeptical accountant eventually asks. That's nice, but where's the cash?
The statement of cash flows answers that question. The income statement measures performance using accrual accounting. The statement of cash flows explains the actual change in cash and cash equivalents during the period.
So the income statement is the movie, and the cash flow statement is the behind-the-scenes footage showing which explosions were real.
That analogy helps, as long as we don't call accrual income fake. The two statements measure different things. Net income records revenue when earned and expenses when recognized. Cash flow reports receipts and disbursements.
And every cash flow goes into one of three buckets: operating, investing, or financing.
Think of a restaurant. Operating is running dinner service. Investing is buying or selling the building and kitchen equipment. Financing is obtaining money from lenders and owners or returning money to them.
Operating runs the machine. Investing changes the machine. Financing funds the machine.
That's the big picture map. But classify transactions by their economic nature, not merely by an account's name, or whether it appears as current or non-current.
First, what belongs in the cash pool?
Cash includes cash on hand and demand deposits. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amounts of cash and have a maturity of 3 months or less when acquired.
The trap is looking only at the time remaining at year-end.
Correct. A longer-term investment does not become a cash equivalent, merely because its maturity date is approaching. Also, transfers between cash and cash equivalents are not reported as cash flows. The entity simply moved value within the same cash pool.
Left pocket to right pocket. No cash flow parade required.
Exactly.
Operating cash flow can be presented using the direct or indirect method.
Only the operating section changes. Investing and financing are identical under both methods, and both methods produce the same net operating cash flow.
The direct method lists cash collected and cash paid. The indirect method starts with net income and repairs the difference between accrual income and cash.
For the indirect method, use CLAD, current assets and liabilities, losses and gains, amortization and depreciation, and deferred items.
CLAD sounds like an accountant who carries a sword.
Today, his sword is a working capital schedule. Start with current operating assets. An increase is subtracted from net income. A decrease is added.
Accounts receivable up means revenue exceeded cash collected. So, subtract the increase.
Right. Inventory up generally means cash was used to acquire inventory that has not yet reached expense, so subtract the increase. Prepaid expenses up means cash paid exceeded expense recognized, so subtract the increase.
More operating assets usually means more cash tied up.
Yes, but keep the word operating. Do not adjust cash itself, equipment, investments, or every account labeled current.
Operating liabilities move in the opposite direction.
An increase in an operating liability is added. A decrease is subtracted. If accounts payable increases, the company recognized purchases or expenses without paying all the cash, so the increase preserved cash.
The supplier temporarily financed the company.
Exactly. If accounts payable decreases, the company paid obligations from an earlier period, so subtract the decrease.
Let me lock in the pattern. Operating asset up, cash flow down. Operating asset down, cash flow up. Operating liability up, cash flow up. Operating liability down, cash flow down.
Correct. But a short-term borrowing is still financing. Its current classification on the balance sheet does not convert it into an operating liability.
Economic job beats balance sheet address.
Precisely.
Now the weird part. Subtract gains and add losses.
It only seems weird because we are not measuring whether an event was favorable. We are removing items from net income that belong to another cash flow section.
Suppose equipment with a carrying amount of $20,000 is sold for $25,000. Net income includes a $5,000 gain.
The full $25,000 proceeds belong in investing activities. Therefore, subtract the $5,000 gain from net income in the indirect operating section. If the sale created a loss, add the loss back.
The gain is not the cash. Remove the gain from operating, then report the full proceeds in investing.
Exactly. but do not reverse every gain automatically. First, identify where the underlying cash transaction belongs. Gains and losses related to operating transactions may require different treatment.
The rule comes with a trapdoor. Lovely.
That is why reasoning matters.
Depreciation and amortization are simpler.
They reduce net income but do not require current period cash payments, so add them back. The original asset purchase was an investing cash flow when it occurred. Current depreciation is merely the allocation of that older cost.
Depreciation is the expense echo of an earlier cash purchase.
A very useful analogy. Other non-cash expenses generally follow the same logic. Deferred items also create differences between income recognition and current cash. Ask whether the item affected net income without affecting operating cash by the same amount.
So, CLAD is 4 families of disagreement between income and cash.
Exactly. Current operating accounts create timing differences. Gains and losses may belong to another section. Depreciation and amortization are non-cash. Deferred items separate recognition from payment or collection.
Quick example, net income is $100,000. Depreciation is $20,000. Accounts receivable increased $15,000. Accounts payable increased $10,000. There is a $5,000 gain on equipment.
Start with $100,000. Add $20,000. Subtract $15,000. Add $10,000. Subtract $5,000. Net operating cash flow is $110,000.
The arithmetic is easy. The direction is the exam.
Exactly. Before calculating, ask what net income included, what cash actually did, and which section owns the cash flow.
Let's classify the major transactions. Operating activities first.
Cash collected from customers is operating. Cash paid to suppliers and employees is operating. Under USGAAP, interest received, interest paid, dividends received, and income taxes paid are generally operating.
Dividends paid are financing, though.
Correct. Dividends received are operating. Dividends paid are financing because they return capital to owners.
And borrowing principal is financing, while paying interest is operating.
Right. Issuing debt creates a financing inflow. Repaying principal creates a financing outflow. Interest paid is an operating outflow.
The loan is financing. The rent charged for using the lender's money is operating.
That works as an exam analogy.
Investing activities generally involve long-term assets and investments.
Buying property, plant, and equipment for cash is an investing outflow. Selling those assets creates an investing inflow. Making a loan to another entity is investing. Collecting the loan principal is investing, while collecting interest is operating.
Principal and interest must be separated.
Yes, purchases and sales of long-term debt or equity investments are generally investing. But actively traded securities may be treated as operating based on their purpose, and transactions involving cash equivalents remain within the cash pool rather than appearing as cash flows.
Financing activities deal with lenders and owners.
Issuing debt or stock creates financing inflows. Repaying debt principal, repurchasing shares, and paying dividends create financing outflows.
Operating asks whether the business generates cash. Investing shows what long-term resources it buys or sells. Financing shows how capital enters and leaves.
That mental model also helps with mixed transactions. Suppose equipment is acquired by paying $40,000 cash and signing a $60,000 note.
The $40,000 is an investing outflow. The note portion involved no cash.
Correct. The $60,000 non-cash portion is excluded from the body of the statement and disclosed separately as a non-cash investing and financing activity.
So, the cash flow statement refuses to pretend the note was cash, but the disclosure refuses to let the transaction vanish.
Exactly. Other examples include acquiring assets by issuing stock, converting bonds into equity, and exchanging non-cash assets.
Now, the direct method. Sales revenue is not necessarily cash collected from customers.
Right. Accounts receivable is the bridge. If receivables increased, cash collected was less than sales revenue. If receivables decreased, collections exceeded current period credit sales.
For suppliers, inventory and accounts payable create two bridges.
Correct. First, connect cost of goods sold to inventory purchases. Then connect purchases to cash payments through accounts payable. If inventory increased, purchases exceeded cost of goods sold. If accounts payable increased, some purchases remain unpaid.
Reason through the business story instead of memorizing a fragile formula.
Exactly. The same idea applies to operating expenses. Prepaids connect cash paid in advance to expense. Accrued liabilities connect recognized expense to cash paid later.
Direct and indirect are two camera angles on the same operating cash.
Yes. And when the indirect method is used, supplemental disclosure is required for cash paid for interest and cash paid for income taxes.
Because those actual payments are not obvious from the reconciliation itself.
Correct.
At the bottom, operating, investing, and financing cash flows reconcile beginning cash and cash equivalents to ending cash and cash equivalents.
But remember, a statement can reconcile and still contain classification errors. Moving an investing inflow into operating leaves total cash unchanged, while both sections are wrong.
A balanced mistake is still a mistake.
Exactly. Let's finish with a rapid test.
Equipment purchased for cash.
Investing outflow.
Bonds issued for cash.
Financing inflow.
Bond interest paid.
Operating outflow.
Bond principal repaid.
Financing outflow.
Dividends received.
Operating inflow under U.S. GAAP.
Dividends paid.
Financing outflow.
Land sold.
Full proceeds are an investing inflow. Subtract any gain from net income or add back any loss in the indirect operating reconciliation.
Equipment acquired by issuing stock.
No cash flow in the statement's body. Disclose the non-cash investing and financing activity.
Accounts receivable increases.
Subtract the increase.
Accounts payable increases.
Add the increase.
Depreciation expense.
Add it back.
The entire module comes down to 3 questions. Did cash move? Why did it move? Did net income include something that must be adjusted?
Exactly. If no cash moved, consider a non-cash investing or financing disclosure. If cash moved, classify it as operating, investing, or financing. Then use CLAD to reconcile net income under the indirect method.
Current assets and liabilities, losses and gains, amortization and depreciation, deferred items.
Keep the restaurant in mind. Operating runs dinner service. Investing buys or sells the kitchen. Financing deals with lenders and owners.
And keep the exceptions visible. Interest paid is operating even though principal is financing. Dividends received are operating while dividends paid are financing. Cash equivalents stay inside the cash pool.
Most importantly, separate accounting recognition from actual cash movement. Once you do that, the statement of cash flows becomes a logical reconciliation rather than a collection of signs to memorize.
Follow the cash, classify the relationship, and let CLAD handle the timing.
That is FAR.F5.M5.